Okay, so welcome back, right? And now I want to give you the principles of market range. Okay, so these are the basically the laws that guide the way you are going to use this concept of the market range and how you I and how to trade with this idea. So the first principle of the market range is that the market range occurs when there's an imbalance in price. So there has to be some type of sharp movements in some direction. Okay? So if the movement is down, for example, there has to be some type of sharp movement downwards. That sharp movement downwards is an imbalance in price. Now, the market doesn't like imbalances. If the market sees an imbalance, it wants to rush in and crash that imbalance, it wants to close it. So when that imbalance is created, it leaves a range, and that range has an equilibrium. The equilibrium will be the 50% of that imbalance. So say that this downwards arrow that I'm depicting is our imbalance. The equilibrium is going to be just using like just eyeballing it. Obviously, equilibrium will be somewhere like here, right? I think that's a good point to draw equilibrium, guys, right? So, if this was the imbalance created, if this it was the range created, then our equilibrium will be somewhere here in the middle. 50%. Now, that range has an equilibrium. That's the first principle. The second principle is the bottom portion of that range is going to be a discounted area. Participants in the market will look at the lower 50% of that range as a discounted area. Does that make sense to you? They're going to look at this part, the lower 50%, and they're going to look at it as a what? As a discount. What is a discount? Well, guys, it's literally the same thing as when you go to the grocery store, right? So usually you go and you buy a pack of cigars for $12, but let's say on some other day you walk in and they're selling it for $6. So instead of buying one, you end up buying two. You know why? Because you can spend the same amount of money and get more. It's the exact same thing here in the market too. So when the price is in the lower 50% of that range, investors will see price as a discount. Now, contrary to that idea, let's move that back here. The third principle of the market range is when price is in the upper 50% of that imbalance. When price is in the upper 50% of that range created by that swing. You remember our little diagram here? This was the imbalance, this arrow, and this is the 50%. This line is the 50%, that's the equilibrium. Well, when price is in the upper half, okay? When price is in the upper half, that's a premium. Investors will consider price to be expensive when price is in the upper half. Same with the grocery store. You walk in for a pack of cigars, usually it's $12. Then you walk in on a day when it's really busy or something happened, and now they're selling it for $15 for a pack. So it's the same thing. The upper 50% is the premium of that range. Now, what does this imply? Institutions sell premiums. Put this in your notes, guys. Institutions sell premiums. If you want to trade, in line with institutions. So when prices in premiums, institutions sell premiums. They don't buy in premiums. As a matter of fact, the banks on Wall Street, they are not allowed to hit the buy button when price is in the premium of a range. When you want to buy the cheapest price. So when institutions sell, they sell at premiums. Now, the counter of that is institutions buy at discount. Institutions buy at discounted prices, guys. Institutions only buy when price is in the bottom 50% of that range. Institutions only buy when price is in a discount. Okay? So make sure you write that in your note and study it. Okay. Okay, ladies and gentlemen. How do you spot these impulse swings on a chart? Just observe any price chart. Look for where you see sharp moves away from a certain point. That's usually the beginning or the end of an impulse swing. So if you look at this chart, for example, if you bring your attention all the way to this top, when price reaches the top of this candle at this high of 401.49, as you can see, the numbers up here. What do you see after that? When price reaches that high, you see a sharp decline and price tumbles and tumbles and tumbles all the way from 149, I think that was the number, all the way to $11. Okay? So, oddly enough, like I said, when you see sharp moves away from an area, that is usually the beginning of an impulse swing. If you bring your attention down to this bottom left of the chart where my mouse is, do you see that this is the beginning of an impulse swing? Sharp move upwards. And do you see how when price reaches this high, the high of this white candle, 105.58, it sharply declines? You see you have 3 down close candles following it. Okay? Now when price gets to this low of 42.51, the bottom of this blue candle, do you see how price sharply reacts back upwards? Lethargic move up, and that move ultimately leads to this high. So when you see that sharp move away from somewhere, that's usually the beginning of an impulse swing. And impulse swings, they will start somewhere, they will end somewhere. So this impulse swing starts at this low of this candle, if you bring your attention to the bottom, and it ends somewhere. It ends here at this high. This impulse swing, this guy right here, you see what I'm saying? This impulse swing. This bad boy starts right here at this bottom, 42.51, and it ends somewhere. If you bring attention to this top is at 401.49, and it leads to this entire swing. It leads to this entire move downwards. That's the beginning of this entire move downwards. And it ends somewhere. It ends here. As you can see, observe from the chart, at the low of 12.01. So impulse swings will always start somewhere and end somewhere. And when those impulse swings happen, they create a range. So this is what we're talking about, guys. And another thing to understand is swings are trend-based. Okay? Price swings are trend-based. So these impulse swings, when the trend is bullish, then the impulse swings are going to be upwards. In this portion of the chart, okay, John? In this portion of the chart, let me change the color so you can see it a little bit, clearer. In this portion of the chart, you can see that the trend is obviously upwards, right? The impulse swings are going to be in the upwards direction. So these retracements that you see, these three down candles, that's what you call a retracement. That's what you call a pullback, or whatever the vernacular you may want to use. The whole point of that is that price dips back into that range created by that impulse swing. And ultimately, because the trend is upwards, we believe that we will have another impulse swing upwards. So you don't want to be taking the short positions against the trend, because the impulse swings that have the money, the volume of orders to push price with such sharp lethargic movement, as you can see with this big candle, you see how this single candle right here is larger than these three candles combined. Is larger than these three down close candles combined. Okay? So you want to be on the side of the trend. So in a situation where the trend was downwards, for example, in a situation where the trend was downwards, as you can see here, right? The impulse swings that you'll be expecting, let's take from here. The impulse swings that you'll be expecting, or you should be trying to monitor, which should be impulse swings to the downside. There will be sharp lethargic movements to the downside. And then you will see retracements back into that range created by that impulse swing. And then you see another sharp lethargic move downwards, and it continues. And that impulse swing will always be in the direction of the trend until the trend changes. So when impulse swings are created, they leave ranges. And using the principle of market ranges, we know that when a range is created, that range will give us an equilibrium point, it will give us a discount, and it will give us a premium. Okay? So when the market is in an uptrend, you want to be buying the market if it comes into a discount. And when the market is in a downtrend, you want to be selling the market when it comes into a premium. In other words, you want to be buying declines when the market is in an uptrend, and you want to be selling rallies when the market is in a downtrend. So we're going to consider this portion of the market right now. When the market is moving upwards, this is the time in the market when it's in an uptrend. And the tools we use to map out the tools I use to map out market ranges is the Fibonacci. Now I'll show you two versions of the Fibonacci, which basically tell you the same thing. So this 50% will show you the equilibrium point. One section should show you the discount portion. One section should show you the discount portion. And one section should show you the premium portion. So one section shows you the discount, one section shows you the premium. That's the Fibonacci tool. Okay. Now, the other version of the Fibonacci tool is basically the same thing. It just has two more data points plotted on it. So I wanted to show you this so that you can have a more in-depth and technical background in the Fibonacci. The Fibonacci premium has areas, optimal data points where you can expect a sharp retracement from price. So what that means is price creates an imbalance. We expect price to return to equilibrium. Remember, I told you that price wants to be balanced. Price wants to be in equilibrium, or at equilibrium rather. But in a situation where the market is trending downwards, right? So you have a market that is, you know, moving like this. You remember the principle I told you? Institutions want to sell premiums. So in a situation where the market's in a downtrend, meaning that the institutions who are making money are short in their positions, then when the imbalance occurs, when this impulse swing is created, like all the ones I've shown you today, and price returns to equilibrium, institutions will not just be satisfied with price returns to equilibrium because they're greedy and they want to make more money. They would rather have price return deeper into a premium, right? So if you want to sell, you could either sell when price returns to equilibrium, the 50%, or you could sell at an even higher price. If you sell at an even higher price, you're going to make more money. So that's what they want to do, right? So that's where this idea of the optimal entry points comes in. And what it basically is if the market is in a downtrend and an imbalance is created, price will not only want to return to equilibrium, it will want to reach into a deeper level in the premium range. And likewise, if you flip the script, right, and the roles were reversed, and the market was in an uptrend, in a market that's in an uptrend, price is going higher. Because institutions are greedy, they want to make sure that price keeps on going higher, so they keep making money. But they can only buy at discounts. So when an imbalance is created upwards, when price shoots upwards lethargically, creating this imbalance, it will want to dip back into that range all the way into the equilibrium. But just with the same as the sellers, institutions are not happy at just equilibrium. If they have the opportunity, they would love to buy at even cheaper prices. So a lot of times you will see price not only reaching into the equilibrium of that range, price would reach deeper than equilibrium into the optimal trade entry points before making its move back up. And that is why I've shown you these two versions of the Fibonacci. So this version I will use to show you the premium and discount concept on the charts, but I wanted you to be aware of the idea of an optimal trade entry point where institutions are more likely to reach when it comes to an uptrend, and it will be in the discount area, and when it comes to a downtrend, it will be in the premium area.